This will nationalize the big banks. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, banking insiders revealed the unthinkable could now happen as the next big set of banking regulations is coming, and what could follow that is the beginning of nationalization of our big banks. We'll take a look at what these regulations are, why they're so bad for the big banks, and how the next step could be the beginning of a government takeover. And while Fed Chair Powell is running a victory lap as the labor market looks strong, we're going to show you why the banking industry is really the power behind the economy, and how Powell is going to find out that his hopes of a labor market recovery is actually going to lead to a massive amount of unemployment. Will there be a congressional fiasco over the debt ceiling? We'll take a look at that. And has the global economy already entered a recession? We're going to make the case of why it actually has. And stay tuned tomorrow. We have an AI company who's sponsoring the show, and there's a real interesting twist to their sponsorship. So be sure to tune in tomorrow to find out. But first now, let's head over to Morgan Stanley, where we picked today's story up. With the Basel III endgame is coming, they say get ready for tougher capital requirements. Now, if you're not familiar with what Basel III is, it's the set of international banking regulations. And what is following this, and what Morgan Stanley is suggesting, is we're about to see the end of the Basel III regulations, and coming soon is going to be the Basel IV. And then I'm going to make the case of why you could start to see partial nationalization after that, because there is a point when more regulations actually are going to be very damaging, not to the banks, but to the broad economy that just will not be able to recover. Time to get ready for Basel III endgame coming this summer, Morgan Stanley says, as we expect Fed Vice Chair Supervision Michael Barr will publish a notice of proposed rulemaking detailing new bank capital rules sometime between Memorial Day and July 4. After the NPR comes a comment period followed by the final rule. Now, when you're talking about bank capital rules, this is important to understand, is the regulations determine how much capital the banks need to hold. Now, what's really key here is the more capital a bank has to hold against the assets or their loans, whatever they're doing, the less money they can lend out. And this is key because we are in a debt-based economy. Now, while there is good debt and bad debt, broadly speaking, as the debt expands, well, so too does the economy. So when you think about the banking industry and why this is so critical, if you put in more and more regulations to prevent the banks from doing what banks need to do, which is beyond holding deposits, which is lend money, well, next thing you know, you've caused a massive problem with the money supply growth and other factors, which I've got a bunch of charts to show you here in a little bit. And so if you've kind of wondered why, these small and regional and mid-sized banks were so critical to our system, because they're not under the same set of rules. And so you look at, say, First Republic, and the big banks came in and put $30 billion in it. The real mistake they made was either not putting more money in it or helping First Republic offload some of those bad assets, or at least the unrealized losses, to keep them solvent. Because the reason we need these small and mid-sized and regional banks is because they can actually create loans, and that means creating new money into our system. So this is really critical. When we start to hear more regulations lead to more capital, not a good thing. So why does this matter? Well, we expect the Basel III endgame implementation will drive up risk-weighted assets, or RWAs, and capital requirements. So they're saying here is, look, they're going to reclassify certain things at a higher risk level, and with higher risk levels are going to mean banks need to hold more capital. So what you're starting to see is a response to this banking crisis, suggesting that the problem is, as it's always been, the banks just don't have enough capital that they're being forced to hold. So since they're not going to do it, well, we'll just pass more regulations. It just goes to show that these regulators don't get it at all. And while it's hard to know the exact impact of the rules, we went through the details. We're going to look at that because this is going to impact the GSIBs, or globally systematic important banks. These are the big banks. And here you can see the first thing that Morgan's looking at is a fundamental review of the trading book. But get this, the first sentence, the FRTB will raise capital requirements for trading activities by applying more specific risk calculations against individual asset classes and trading desks. Again, more capital needs to be set aside. And I want you to see this as a recurring theme here as we go through this. Operational risk. Well, we saw a whole bunch of that recently, as regulators will be adding operational risk to standard approach risk-weighted assets meant to measure risk related to failed systems. Think about some of these things we just saw. External events. You could code that for perhaps people tweeting about bank failures causing bank runs, third-party risk, model risk, conduct risk, technology and data risk. Of course, there's little detail on how the regulators will calculate and layer on operational risk, but the intent is to combine a financial statement proxy of operational risk exposure with bank-specific risk. Translated simple, more capital requirements coming to the banks for regulations that we're not even sure what they could be, but you can only imagine. It just means banks are going to be doing less of what banks need to do, which is lending, and sitting on more types of cash and other securities. How about the advanced approaches will go away? The end game will result in one standardized risk-weighted asset calculation down from the current two. Look at this. You see, we expect risk-weighted average market risk for the covered GSIBs to increase from 5% to 8% of total standardized risk-weighted assets, and operational risk-weighted assets to increase from 0 to 2 to 7%. Again, all that means is more capital, less lending. So you start to think about where this is going. You know, first we have Basel III, now we're going to have Basel IV. What would be next, right? Would there be a Basel V or a Basel VI, a Basel VII? At some point, they're going to come to the conclusion is, look, the banks have all of this capital, we're making them risk weight against everything, and still we're having problems. And then you'll start to find out that, wait a minute, the economy now can't grow. We're actually potentially then at a point where disinflation or deflation becomes the norm because there isn't money creation. And then you start to look at the research from someone like Russell Napier, who has been interviewed several times by my friend Brent Johnson, who's got the dollar milkshake theory. You may have heard of him. And in those interviews, Russell talked about how the government might start to come in, kind of like the Paycheck Protection Program, and force banks to lend and push money out into the economy. Because if you take away the power for the banks to lend, the U.S. economy, the global economy can't grow. And next thing you know, the government starts to step in and say, look, if you can't do what you're designed to do, which they can't because of overregulation, we'll just force it. And then you start to move in to partial and eventual full nationalization of the banks. I want to know what you think. Do you think that's the path we're headed? Do you think I got it wrong? Is there a different path? I'd love to know. Weigh your comments into the, or weigh your opinion into the comment section, because Morgan goes on to say here that, look, there's going to be a fallout from this, and I want you to see that the fallout is happening now, and only what we're going to see is if these regulations come through, it's going to get a whole lot worse for the banks and the economy. Here from this headline from Zero Hedge, Morgan Stanley, new banking rules will make credit standards even tighter. So what that means simply is that when you go to the bank and get a loan and they ask you for all kinds of collateral or information to verify that you can pay the loan back, what this is saying is, look, those conditions are going to get tighter, which means less money is going to be lent out, less money is going to be created in the economy, and that ultimately is going to lead to less economic growth and perhaps, as I'm going to suggest, periods of outright deflation. Let's make the case for this as we first start with this chart here. And this is from the Senior Loan Officers Opinion Survey. Now, we should get a new one of these reports tomorrow from the Fed, and they're reporting on tightening standards. Now, I want you to see what we've got is a bunch of different kind of tightening standards in the colored lines here, but I've circled some stuff down here. So 94, back when I graduated high school, the lending standards started to tighten. There was kind of a soft recession following that, kind of the ideal situation, what the Fed wants. Then what happened? You see lending standards tighten again, dot-com bubble, happen again, global financial crisis, start happening around 2015, 2016. What do we have? Almost a global recession. And then the pandemic obviously tightens up, and now we're starting to see it again. I want you to notice that these tightening standards are consistent with outright financial crises. So let's take a look at this next chart, because what this then implies, if credit is being tightened and people can't get loans, then what should we first then see? The first order effect after that is we should see the banks originating fewer loans. And we do see that throughout history. When we look at commercial industrial loans, we've got that here in red on all commercial banks on a year-over-year rate of change, and that's against the net percentage of domestic banks tightening standards for commercial industrial loans of all size firms. And what do we note? When that blue line goes above the black line, anywhere it's above the horizontal black line, it notes that banks are on net tightening financial standards. What happens? Commercial industrial loans eventually come crashing down and actually go negative on a year-over-year rate of change. What happens during the global financial crisis? Look, lending growth, kaboom, goes right down into contraction. We see it during the pandemic, and look what's happening now. Financial conditions are tightening, lending standards are tightening, and the commercial industrial loans are heading down and eventually likely to contract. And what does this mean for the broad money supply? Because most people believe that the Fed's behind the money supply. I want to show you it's really the banks who are the ones who are creating money. The Fed can't print money. We know that. So let's take a look at this chart. And what do we see in the M2? Of course, is banks are tightening standards, was keeping that the same in the blue line. What falls with the money supply is you see that it decelerates. Not contracting here because it's got to go below this zero, this line way down here, but you notice the slowdown in the money supply makes perfect sense. Look at the global financial crisis. You see that slowdown happens again, makes perfect sense. And again, with the lag, you see it following, of course, the pandemic. But look at now, it's in a contraction. And as long as the banks keep tightening standards, originate fewer loans, what you're going to see is a further contraction in the money supply. And as we've noted in the past, that is very, very rare and often leads to an outright depression or severe economic crisis. We know that's coming. And of course, many people say, but still, Steve, we could see inflation. Well, according to the bank's tightening standards, unlikely as well. Let's take a look at this chart here. We have the consumer price index now overlaid against that net percentage of domestic banks tightening standards for commercial industrial loans to all size firms. What do you know? As again, the banks tighten standard, what do you see? Fewer loans, less money being created in the economy, inflation comes down. You think about from the demand perspective, if you want to go buy something but you can't get a loan for it, what is the net effect of demand? Well, it's going to be reduced, so we should see inflation come down. Sure enough, what happens during the global financial crisis? The same thing happens. Banks tighten standards, inflation goes up, comes crashing down into deflation. We see that happen during the pandemic. We're seeing it now. So the path, of course, what we know for the consumer price index, as we're likely to see in the future, is lower. But one thing that should be turning up, that is your portfolio. When you have the power of the CTA-Timer Pro report, this report from yesterday, we of course looked at this over the weekend. If you're looking how to buy low, you want to follow what the machines are doing. My friends, this is so easy. It only tells you how the machines are positioned. It does it with a historical overlay. You want to know what's low on a historical basis? Find the ones that say minus 100, or really close to that. Put those on your watch list. You'll see all the feedback I get. Steve, this is the easiest report. My trading has gotten so much better since I've added this report. It's $30. Link in the description below. Price going up soon. But how about Powell's bet against the recession? Well, we're going to make the case. Well, he's got it completely wrong. And we're going to go back to the banks to do that because according to this article from Bloomberg, Powell's bet against recession looks good. Might as well the credit crunch, the DC standoff. Oh, and while we're at it, let's not forget El Nino because, hey, if you can't find something else to blame it on, let's, of course, blame it on weather. But check this out. In Powell's view, the gravity-defying strength of the American labor markets on display again in the jobs data. So again, the fixation of the Fed is the jobs market. I'm going to destroy that here in a moment, which showed a bumper increase last month, is smoothing the way for soft landing even after 5 percentage points of interest rate hikes in a little over a year. It's possible that this time is really different. The argument is, of course, it's always possible this time is different. It's also possible the U.S. government will default on its debt. But guess what? It's not any different than any time before. And check this out. We've gone back to that same chart of the net percentage of banks tightening standards for commercial industrial loans of all types, now overlaid the 4-week moving average of initial claims. So I want you to understand as we look at this, what have we seen now? Inflation coming down because banks tighten standards. Money supply coming down because banks tighten standards. We also see loan origination coming down because banks tightening lender standards. What should that ultimately lead to? Less demand, less money, and less need for people to work. And sure enough, what do we see? As banks tighten lending standards, sure, we can see the unemployment claims fall, and then all of a sudden they start to move higher as you get up in these upward levels around up where you see kind of around this 40. Look at this. You see it, banks tightening standards up to that level, and boom, next thing you know, people are out of work. We see that headed into the pandemic, but that was kind of a one-off to this broad picture here. But look now, we're up at that 40 number here. You see it up here, and what are we starting to see? We look at it every week. The beginning of what could be a breakout higher in initial claims. But of course, from the Fed's perspective, let's take a look at what's going on. Can they get by this looming credit crunch? Well, I just made the case not going to happen, as it's driven by the combined impact of Fed tightening and bank failures. It will likely hit small business and commercial real estate. Boy, we've made the case. Commercial real estate is going to get battered, and that has happening just because of the pandemic and people working from home alone. You talk about all the credit crunch on top of that. Man, commercial real estate, big danger here. The debt ceiling deadlock in Washington, well, we'll take a look at that in a moment. Coming to a head right now, the partisan standoff threatens a period of intense financial stress. If they default, could be a crash bigger than the 2008 crash. Not likely to happen, but it could. And a climate wild card from El Nino. The weather system is gathering force, threatening extreme conditions around the world that would disrupt commodity supplies, push prices higher, keep the Fed focused on inflation. And if this trifecta does tip the economy into a slump, there may not be much Powell and his colleagues can do about it. Rate cuts are the main recession-fighting tool, but it's tricky for the Fed to deploy them when it's still struggling to bring inflation back to target. Of course, nothing would be more deflationary than a banking crisis and a global recession. We'll make the case here in a bit why that global recession may have already started. First, let's talk about this debt ceiling. Are we going to have a constitutional crisis? Well, Yellen, she is, of course, as we know, the Treasury Secretary says no good alternative to Congress lifting the debt cap. Of course, we know Congress has to do this, and President Joe Biden is scheduled to meet with House Speaker Kevin McCarthy here on Tuesday, tomorrow. Of course, they're locked into a stare down, and they don't want to consider emergency options, Yellen said. What she wants is Congress to do its job, and what to do if Congress fails to meet its responsibility? Well, there's no good options, and that's why ultimately at the end of the day, and it may be in the final hour of the final day, which is targeted right now, estimated around June 1st, what you'll see is some sort of temporary extension as the negotiations go on. But for now, one thing that says the economy's booming, well, maybe not for long, is oil. As oil climbs almost 3% as recession fears begin to fade, but as oil's days numbered, well, let's go back to that banking chart where we have net percentage of domestic banks tightening standards for commercial industrial loans of all sizes against crude oil prices. This is West Texas Intermediate in red. And what do we know? As banks tighten standards, you can see crude prices rise. But what happens? They eventually come crumbling down. We see that again in the global financial crisis. We see that during the pandemic. We're starting to see that now. Everybody remains really bullish on energy. And look, I get all the reasons why. That a slowing global economy, a global recession, tighter credit conditions all mean less demand. And one place we're seeing that is in Germany. As German industrial output slumps, recession fears rise. In March, German industrial orders, get this, fell by 10.7% from a previous month on seasonally and calendar adjusted basis, posting the largest month-on-month decline since 2020 at the height of the COVID-19 pandemic. Look, imagine, if something in your life fell 10%, maybe it could be your weight, it could be your income, it could be anything. You look around and anything in your life, your business that falls 10%, maybe it's your portfolio, anything, and you go, wow, that is a major hit in your life. Something's gone wrong. This is happening to the biggest economy, the industrial output base of the European Union in Germany. Bad news going on there, as German manufacturing is suffering more and more from the global rate hikes, which are increasingly applying the brakes on the economy. The risks of recession in Germany, they're not just rising, I think they're there and soon to spread to the rest of the world. And all this tells me is we're on a path to the eventual nationalization of the biggest U.S. banks. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.